Okay, so good night, ladies and gentlemen. So we're going to be discussing Volatility 25 index tonight. So we're going to be doing a quick markup on Volatility 25, and we're going to be focusing on, looking at how it makes this market tick, where the current market is at, and let me just revert the market back to inverted, inverting it back to the original chart. So looking at the volatility index chart, 24 hours, or the one-day chart, the first thing we must always identify on a chart is the trend and also the major swings of the market. And for that, we need to understand the order flow via trend. So we know based off the major swings, firstly, we identify a swing low for the external market, swing high, no present swing low as yet. So we have a previous swing low and a swing high pertaining to the current market for volatility 25. We could maybe go back a bit and see what previous swing highs are there, and it would have been this one currently, because this high would have been higher than this current high right here, and this would have been the low that put in the high that we have here. Or maybe it would have been this one. Yes, that's the one. So by looking at this, we could say easily that we have a breakup structure. And if we have a market that is giving us a breakup structure to the upside, this confirms that the external order flow of the volatility 25 market is bullish. However, that is not something that will assist us in taking a trade. So let's focus on the current area of the market that is valid to price. This previous swing and this previous swing points. Now looking at the order flow now, we're going to be looking at the trend within the external swings, and that trend is going to be this upward trend previously that we had. And also the current downward trend that we now have right here for the order flow. So the previous order flow of the volatility 25 market was bullish, and now the current order flow is bearish. Wonderful. Now, what we know via markets, as we would have explained before or in the previous videos, for those who know, we know that no matter the market that you're in, if it's a buyer's market, this market is going to be operating from a place where it buys in discount, which is below the 50%, the 0.5%. And we also know, if I invert this, if a market is a seller's market, it's going to sell above the 50%, which is an area that we call premium. Just like when you buy a car and you fix it up, turn it into a sports car, maybe add a few rims, looking pretty rims, you drop it, give it a good spray job, and you're going to be selling that back for a couple $1,000 more than you bought it for. We're selling it the market here at a premium price, where you bought it at this discount area, you're going to be selling it at this premium area, right? You exit and you're going to be selling to make a profit, and you're going to exit at discount. Okay, wonderful. Now, when you're looking at order flow of a particular market, and the market is within the areas where we could say safely that this market in particular has pulled back below the 50%, into discount, we can now enable ourselves to start looking for some kind of market structure shift that would indicate that this market now is transitioning from this current downtrend that is in back into an uptrend. And it is going to be that change, the schematic of that particular change, that we will learn to understand, and that's what we are going to be looking for or waiting for. But in the meantime, let's look a little bit closer at the chart and see what is taking place and what we can understand about what has taken place according to price in the market. Okay, let's move down to the 4-hour time frame of the market. And a personal favorite of mine that I would like to do, what I do all the time, I like to invert my charts to give me a different perspective of market structure. So let us look at this current era of the market. And our perspective of this market is going to be looking at getting a break of structure at this area. And between these major swing points, going back into premium, or since it's inverted, it's premium, but it's originally discount, is going into premium now. What would be the point of interest, and what makes it the point of interest as to why the market would be attracted to that area, and what liquidity is dragging the market to that specific area? So first, we have to look at this uptrend that happened, where it broke, and what caused the push of the market from this area to here, and why the market has to go back here to look to a particular point of interest to initiate another sell sequence. All right, let's use the line chart to take a closer look. So we can see that we have here an uptrend in the market. Now, in looking at this uptrend, we can clearly see that we had a low that put in an external low that put in an external high. This external high put in this external low. We have here an internal structure. This is one movement up, and this move put in this main external high that we have here, but we're still going to see that this low put in this internal high, change the color to red, and this high put in this internal low, and this low put in this external high, and this external high put in this external low. Right? Let's change the color to green. This external low put in this external high, and this high was where we broke out of the uptrend. This is where the uptrend was broken out of this specific area of price. That was where we had a market structure shift. And this market structure shift now is our first indication at the market converging from an uptrend to a downtrend. Okay. Now, this pivot point of the market is always a crucial point, because what we can also denote just by looking, an area where we have a break, such as this one. It's an area that the market is clearly respecting throughout the market. We can see here that the market was once using it as a form of support. Tapped on it, used as a form of support. We can see here it was used as an area of resistance, which it sold from. We can see here this is the area where it first broke back into the area, and we see here this is where it found support and bought back up, found support in this specific area, and used this area here as a point of support throughout until it broke back through, use it as an area of resistance, and push to the downside. So areas where we have breaks like major structure shifts, I call these areas key levels, because these are key levels of price in the market that the market can either use as a table or a floor. It's going to use it as a table where it resists from, or is a floor that it walks on. Likewise, the breaks that we have that break into the buys at these areas. Here we also reside, we have a key level at some point here going across. There is also a key level of price that the market respects, very much so. Okay, let's remove this. Now, looking at this now, let's break it down for a bit. Let's take a closer look and see. We know that in an uptrend or downtrend, according to its sequence, an uptrend or a downtrend has to have a break of structure. The break of structure is basically the starting point of the trend, where you get the first break of structure, second break of structure, third break of structure, maybe even a fourth break of structure. We have to look for the specific start of the trend to know that it is actually a trend. So this major structure shift is just a shift to the downside. We have to wait on the consecutive break of structure that will indicate to us that yes, this is our confirmation now that this is really a starting downtrend. And once we get this confirmation, we wait for the market to create a new low. And this new low, at this point, we are going to, this new low at this point, now we are going to be looking at the market now, using our Fibonacci retracement, and waiting for the market to pull back into an area of premium price, which is above the 50% area, so we can take an entry. And in this case, just looking at this now, the market did pull back into discount, but why didn't it go all the way back up? Let's take a look at that and see what took place. Let's go a bit closer. Now in this area where we had a market structure shift, just like we look at, we had a market structure shift here to the downside from this high, broke down, and the market pulled back. Yes, the market pulled back into the zone to retest. Well, you know what? Let me start from here. This is perfect. So we had a break of structure, or might I say, we had a uptrend, minor uptrend right there. Swing low, swing high, last swing low, last swing high, break of structure, and this was a market structure shift of this area of price. And the reason why this here is a market structure shift is because if we have an uptrend and the trend is going up, according to how the formula works, this should have been an area of demand, and the market should have pulled back in here and continue buying because this is an uptrend. Now, because this uptrend was broken, it created an area, a breaker block. So now previous area of demand becomes an area that is now broken, and we call it a breaker block zone. Funny enough, once this zone is broken back through right here, we call this market structure shift, or might I say, let's put it here. Yes, it should be right here. Yes. So we had a market structure shift right here, and we had a consecutive breakup structure following behind it. And with this breakup structure now, this area would denote that we are started an uptrend. And the uptrend should have been respected when the market came back to this zone to buy to the upside because it brought back market structure bullish. So this should have been a bullish order block to the upside. However, it was broken through again, making this another area of break, or like I call it, a breaker block area. This breaker block area, is a previous area of demand. It's a key area that we look at with regarding it's a key area of demand that we look at where the market has to use as an area of price that it's either going to break through and buy from, and it's also an area that market used to sell from. So this is actually the area that the market retraced back to after we had the market structure shift. Now after the market structure shift, the market did the exact same thing down here. Now mind you, we had a market structure shift coming from this high. This is the high that broke and give us the market structure shift for the external structure down here. Now the break happened here. Now to break back to the upside into price, this is where we had the last up candle, and this is the down candle that proceeded after. So what that meant is that this is where the market had an internal break, shifting back bullish with this upwards trend, and that would have made this an area of demand that was also broken through, not respected, and as we can see, the market failed to come back to the zone to perfectly test it as an area. So this is an open field that is still waiting to be tested. Let's just highlight the upwards candle because this is where we had the market breaking back internally to the downside. So think of this now as an order block. Think of this as the last up candle. Let us say green, and now this distribution that we have here now would be the sell candles, red, that distributed to the downside, giving us this market structure shift here and this external breakup structure. Okay. Now another point that we never touched on in our little discussion here, we never spoke about. Let me clear up some of this. So we never touched on a specific area. Now I had mentioned before that we have the external swings for this trend going up. These external swings here. And I did mention that this is an internal swing that we're looking at. Now, with this internal swing, this is the area where we have the external break. This market structure shift was an internal shift of market structure. But what that says is, on the external side, the markets could have still come back to this area on the higher time frame, and this would have been the external swing for the market to buy back to the upside. Now we can see that at that particular external area, this major external area that we have, let me remove this one, I don't want to cause confusion. At this external point, I'm going to remove all of the small trend movement markers and just keep the main ones. At this external point, the market was supposed to come back here, sweep liquidity, and at this point, this was where the market was supposed to make its grand move following the trend on the external market to the upside. And as we can see, it failed, it tried, buyers stepped in and they bought, heavy rejection. This heavy rejection was signal to indicate that there is no sellers. Sellers are not interested in going higher at this point. And sorry, buyers are not interested. And sellers came into play and distributed, printing an order block. So these last up candles here are the orders that were placed within here, buyers and sellers. And then this distribution now would denote the sell candle, and this would have been the green candle, indicating that we have an order block breaking the zone. Okay. All right. Remove this box. So this would have been our higher HDF time frame market structure shift. And this shift now would provide us with the external movement from this point all the way to this point. So this is a clear indication that will indicate to us that at this point of the market, this is where we're expecting the market to retrace back to, because our grand break came from the grand external, the external high that was here, this external high. And this external high gave us this external low. So if we got an external low from that current high, that goes to indicate that if we use our Fibonacci tool from here all the way down to there, it shows us that we have the 0.05, the 50% zone would be here, and our area of discount where we expect price to reverse would have been the 0.786 area that we were looking at this point. And we can see that we had clear rejections and the market here failed to go higher, instead and swept liquidity, respecting this last upward candle, which is this order block that we have here. This last upward candle, and then we have the red candle now to show the distribution right beside of it. This would have been our area of interest where we are looking to take our entry, and additionally we would have this additional confluence here to show that we're looking at an area of liquidation that should be swept, and we can see that there is a minor gap right there in price which adds to our confluence that this here has to be swept and taken. Okay. Now let's go back to right here. So we had the market structure shift that took place at this particular point. And this is the pivot point of the market. And the break of structure signifies that the trend has started. So where the trend has started at this particular specific point, we can basically say where the order block was distributed, giving us that distribution to the downside, which would have been this here being the last upward candle. And the confirm now break of structure to the downside here, giving us the red candle. This is the order block that we're looking at. So this is our optimal zone that we have to pay attention to, because essentially this is the zone that is responsible for pushing the market to lower prices. This is where it was decided. Oh, you might be saying that it's this high. Yes, it actually is, but this high, that shift here, is responsible for only the correlating trend, which in turn was respected, and this order block was already used at this particular area. Whereas the current one above is still unmitigated, still unused, still an area that we have to take note that the market will come back to be using this as an external area for price to be pushed to the lower regions. Okay. Use the entire sets of up candle. There it is. Though we have used the entire sets of up candles, which is therefore accurate, I'm still going to draw a marker at this point. And watch and see if the market goes anywhere up into those premium zones. That would be a premium area for me. And of course, I would like to see those highs taken out as liquidity. Just as how these highs were taken out as the market pulled back into the order block at this current area. So the same thing has to happen here. Might I say these are also areas of liquidation when looking at the market. Let me delete this. Okay, now let us pay attention again. This was a shift of the trend. This trend, as we see the trend line here, and this is a shift of the overall low to high to low. So this is the shift that signifies the shift that happens between the structure moving from this point to this high point to this low point. This is the shift that signifies to indicate to us that this market is shifting on a more grand basis to go at a larger distance to the downside. And once it's going to be doing that, it's going to create another channel in turn. Hold on. This will create another channel. Pushing the trend to the downside. Just like that. Giving us a downtrend. And just like any other downtrend, the market will be breaking structure, breaking lows, breaking lows, breaking lows, giving us a last break right here to break back to the upside, putting us back in an uptrend. Okay, now focusing on me clear this current one. Now, as we mentioned, we're going to be looking at this area of the trend down. This high is higher than this current high. So this is our downtrend. Okay. All right. This external trend now continues to break lows, going down. And mind you, what we are looking at in common with the trend is that it's breaking lows. It doesn't matter the size of each structure that it creates. It broke a low there. Here was a low here broken. Here was a low here broken. An additional low was broken. And the last low was broken. And like we looked at, and like we know about trends, this last area, the last breakup structure that we have here, if the market reverses and takes back out the high that puts in the low, we call this a market structure shift. And if we get a market structure shift, then the area of the market, which should be the last set of down candles, would signify to us that this was, put that as sell as a red candle, and let us draw another box here as a green candle. This would signify to us that the market printed an order block, bullish order block, at that present area. And if a bullish order block was printed there, it means that a trend is starting. And if a trend is started, it means that we can use this area as an area of demand, and you could have taken an entry right there. Mind you, this chart is inverted. You could have taken an entry, stops right below the order block, aiming for these specific, you could say, since it's a reversal and it's a confirmed reversal at that, giving you a breakup structure on the 4-hour time frame of the external swing, then more than likely it's safe for you to aim for these highs that we have here. You could aim for the order block all the way back to the next entry for the sell in that area, or safely you could just aim for the liquidity on this side of the market, and you could have taken aim and taken entry into that particular point. All right, wonderful. Now, as we have mentioned before, Just like any other trend pattern, the market has to be breaking structure. The market has to consecutively be breaking structure. This indicates that we are in an uptrend, so the market is continually breaking structure. And at each area that the market breaks structure, it prints an order block. An order block is printed. Last sets of down candle, which are these. Let's put that as red. And the green candle here. And therefore, where the market broke structure giving us this distribution is actually where we have our area of demand. And you could have had a second entry here. Well, like I said, the chart is inverted. You could have had a second entry aiming for higher prices to the upside. And that is how you identify your order blocks. That's where you know an order block is. You have to not just see an order block as just a down candle and up candle. You have to see it as the last sets of down candles that cause the effect, and the distribution candles that push to cause that break of structure or market structure shift. Either or either. That's what you are looking for. They are all breaks. Change of character, market structure shift. These are all breaks to the upside. Just looking at taking a closer look here to where we had this specific break, we can clearly see that these distribution candle here, where the body closes above the wick, giving us that break to the upside. So buy candles are signified as, I'm going to signify it as green. And our last sell candles, which have been these candles here, let me place them as red. So our last sets of down candle. And sometimes I like to work with just the body of the candle, specifically just the body. Or sometimes you can just work with the area of the market where the last candle goes down and sweeps the liquidity of the previous distribution candle. But let's not make it complicated. This is your area of demand, and that is why the market pull back into this area after you have gotten the break of structure. That is why the market pull back here to buy to the upside. So you find yourself having inefficiency in the way you're marking up the market, then your problem might be that you're not reading the trend and you're not reading market structure well. And therefore, you're just trading based off greed and your need for money. And if that is the case, you are greatly burning a hole in your pocket and your finances, and you're not actually trading, but you're gambling in the market. And you have to review how you take your trades and review the market. Mind you, this might be the 4-hour time frame. However, the same strategy that I use here is the exact same thing that you would do if you were on the 1 minute time frame, 5-minute time frame, or even the 15-minute time frame. Now, as the trend goes on, we can basically see that we had another distribution to the upside from here. There's another breakup structure. And you know that would signify that this would have been the area of demand, where in which this market would need to pull back to push to the upside. Well, in hopes that it has not created a second breakup structure. However, this would be the point. This is where we had the break. So this would be our optimal area to look for the market to pull back to take an entry to the upside. Nothing confusing, all simple. That is where we would essentially be looking at for the market to pull back, to push into higher prices. For volatility 25, this is our focus. We will be looking to see what the market does once it arrives in this point of interest that we have here lying in wait, POI. And once we see what it does between this coming week to next week, we will know what to decide and how we will take our entries into this specific pair. If this recording any at all was helpful to you on my evaluation of volatility 25 and looking at market structure and identifying and explaining the order blocks, if this has brought new insights to your learning and understanding, please go ahead, like and subscribe to the video, and of course share the video, and of course leave a comment showing your appreciation. Share it to your friends and family members. The more the merrier. Have yourself a wonderful night, guys. Until next time.